Okay, we are about to go through section 2.2, analyzing how transactions affect accounts. And you should have read pages 32 through 36. So I'm just going to go through these pages and we're going to discuss how these things affect accounts. So we're going to start with our chart. I want you guys to make sure that you have your chart out while you're going through these. And we're going to go through these transactions one by one. The first one says, received cash from owner as an investment, $5,000. So the first thing you're going to say is, okay, what two accounts are affected? And we did this last week. We know the two accounts that are affected are cash, because the company received cash, and the owner's capital account. So this is Kim Park Capital. Okay, so we know the debits are on the left and the credits are on the right, but what we want to do is we want to say what happened to our cash. Our cash went up and the capital went up. So let's look at our chart. So we're dealing with cash. If we want cash, which is an asset, to increase, we're going to increase it with a debit. And we're dealing with capital. So here's capital right here. If we want capital to increase, we're going to increase it with a credit. So we are going to debit cash $5,000 and credit Kim Park Capital $5,000. And as I said before, you guys always want to make sure that your debits always equal credits. So we have 5,000 in debits, 5,000 in credits. So we're in balance. So let's see if we can erase the writing on that page. Maybe not. Let's just do this instead. That's probably the easiest thing to do. Okay, next transaction. Paid cash for supplies. We're going to go through the same questions. What two accounts are we dealing with here? Well, we paid cash. We see cash in that, so we know we've got cash, and we got supplies, so we know we're dealing with supplies. Well, what happened to the company's cash? We paid it. We paid cash, so our cash went down, and our supplies went up because we got supplies. So go back to your chart. Now we're dealing with supplies and cash. Now those are both assets. So in order to increase them, we debit them. In order to decrease them, we credit them. So we're going to go back here. We know our supplies increased, so we're going to debit it $275, and our cash went down. So we're going to credit it $275 because it decreased, and you decrease an asset with a credit. So let's go to our third, paid cash for insurance. I think we're on another page now. Let's see. We're on now page 34. So paid cash for insurance, we're dealing with two accounts, cash and prepaid insurance. So we're dealing with cash and prepaid insurance. Now what's happening to these accounts? Did they go up or down? We paid cash, so our cash went down, so we want to decrease it $1,200, and our prepaid insurance, we got it, so it went up. So go back to your chart. Erase these. And we're dealing with cash and prepaid insurance. Those are both assets. So if we want to increase the asset, we debit it, and if we want to decrease it, we credit it. So we're going to go back to our transaction. If we want to increase the asset, we debit it. Debit's on the left. If we want to decrease the transaction, we credit it. Credit's on the right. Debits and credits equal. So we're good. Next transaction. Bought supplies on account from Supply Depot, $500. Dealing with two accounts here. What two accounts are we dealing with? We got supplies, and we see the name Supply Depot in the transaction, so we know we're doing something with Supply Depot. So let's go ahead and put our supplies here. And if we owe someone some money, that's a liability. That's going to create an account payable. Supply Depot. Okay, so let's think about this. What happened to the company's supplies? They increased because the company got supplies. So we want our supplies to increase. And the amount of money that we owe Supply Depot is going to go up. So it's going to increase as well. So let's go back up and look at our chart. And we're going to say, okay, we got some supplies. What is supplies? Supplies is an asset. So we got some supplies. It's an asset. And our supplies went up, so we want to debit supplies. We also have a liability, an account payable. Now our account payable went up, and so in order for it to go up, we credit it. So we're going to debit supplies and credit our account payable. So we're going to go back down here. We're going to debit supplies, 500, and we're going to credit account payable, 500. And let's see, we are now on page 36. I think we're on the last one for this section. Yep, last one. Paid cash on account to Supply Depot, $300. So first question, what two accounts are we dealing with? We see the word cash in the transaction. We know we're dealing with cash. We see Supply Depot, which is the name of someone that we owe money to, so we know we're dealing with that account, which is an account payable. Supply Depot. Now, what's happening to the company's cash? We're paying it out, so our cash is going to go down. Our account payable, the amount of money that we owe Supply Depot, it's going to go down as well because we're going to owe them less money. So our balance with Supply Depot is going to go down as well. So we want to go up here and we want to say, okay, how do we make our cash go down? Well, cash is an asset, and if we want to decrease cash, we're going to do it with a credit. And our account payable is a liability. If we want to decrease our account payable, we're going to do it with a debit. So we're going to go back down and we're going to say our account payable is going to be debited 300 and our cash is going to be credited 300. So our debits equal our credits and we're still good. And the next lesson will be on things that affect owner's equity like revenue, expenses, and drawing.